All right. So I guess let's start with the three questions
Right.
first. So let's talk about the delivery part of it when it has to deliver into a higher time frame point of interest. So, excuse me, sorry. So for example, over here, so like right here, this is a higher time frame, 15-minute fair value gap. So price has to just deliver into that area. That's it.
Right. Right.
So when I mean deliver, price should at least, if in this case, this is the fair value gap, you want to see price come past that first initial level here, right? So price has to at least come into there. That's it. That's delivering into a higher time frame zone, right?
Right.
Um, I saw that it was like, how many ticks. It doesn't really, I don't think we need to put those requirements like how many ticks in. But it just has to come into the zone, right? So if it's a fair value gap or a breakaway gap and it's a bullish gap, price just has to come past the third candle, which is the third candle in the sequence. It has to just come past its low when buying, and when selling, it has to come past the high. That's it. So usually, we know the low is here on the third candle in the fair value gap sequence. Price needs to just come past the low. That means that all right, price has delivered into that higher time frame point of interest. Um, Same thing if you're utilizing a higher time frame, let's say order block. Here, you had an order block. Price has to deliver into the open price, like here. So price delivers into the open price. So you have a bearish order block here, and then you can see is respecting the open price.
Right.
That's it. Um, what qualifies? It was like what qualifies specific highs. So that's what I was talking about with the whole liquidity suite. We want to keep time-based liquidity. So do I have to define what is a daily high?
Wait a minute. Repeat that last part. What liquidity? I didn't
Time,
hear.
so time-based liquidity. So when we're
Time
talking
based.
about, yeah, when we're talking about a liquidity, just to make it easier and it can be defined, it has to be time-based, right? So time-based is going to refer to a yearly high slash low, right? Because that's a whole year. Monthly high slash low, weekly high slash low. Now, this is where we get into the time base when it comes to sessions. My timings are different. So for the Asian session, it's 6 p.m. Eastern until 2:30 a.m. Eastern. That would be the full Asian session. So the high and low, whatever is the lowest price between that 6 p.m. to 2:30, low or highest price, that would be my Asian range. So that's the Asian high and low, right?
Right.
The London session would be 2:30 to 7, right? That would what I would consider the London session. Now, on the chart, the way that the indicator would dictate, say I'm on the 15-minute chart, it's only going to show you basically 6 p.m. until like 2:15. Same thing, I was on a 1 minute, it would show me up until 2:29, right? So wherever the high and low between that time, that would be the Asian high and low. Same thing with the London session. It's going to start exactly at 2:30. And on the 15-minute chart, you'll see it just goes up to 6:45. Same thing with the 1 minute. It's going to go up to 6:59, right? And wherever the high and low is at, that's going to show you the high and low of the London session. Now, New York is divided in two parts, AM and PM. AM starts at 7 a.m. Eastern Standard Time until 11, let's just say 11:29, right? That's the
Right.
whole AM session, right? And then the PM session starts at 11:30 until 4 um, p.m. Eastern Standard Time. Now, when we look at the Asian session doesn't have this functionality, but when you look at the London session, it's broken up into 90-minute cycles. Same thing
Right.
with, right? So you'll see London 1, London 2, London 3. Same thing with the AM session. You'll see it is broken up in 90-minute cycles. Now, a session for me is 270 minutes because, of course, it's three 90-minute cycles.
Right.
That's where the 270 is coming from. So when you see 270 SMT, what it's saying is that one asset is below a session low and one asset is not, if we're talking about bullish SMT. And that's why you'll see that's cycle SMT. Regular SMT, they are comparing the exact price time. So it would be like they would compare 6:30 and 7:30. But when it's cycle SMT, it's whatever is the low within that cycle period. It could be the 90-minute cycle, it can be the 30-minute cycle, etc. Right?
Okay.
So we want to again just stay with cycle liquidity. One thing I forgot to add, and I'm gonna just say it again in the video. So, like I said, we're looking at yearly highs and lows, right? The entire year, the entire month, the entire week. Then the sessions was just 270, right? That's 270 minutes. Then we're looking at 90-minute cycle high and low. We would be also looking at 30-minute high and low. And then lastly, you're going to be looking at 10-minute high and low. So this is where the liquidity sweep must take place. So there's two actions to this, right? If I go to a smaller time frame, it's going to happen two ways. So that's why I'm going to define exactly what that looks like. So for example, even right here, because I took this trade, I took a sell here. This is 3 a.m. I mean 3 p.m. Sorry, this 3 p.m. Right. So now 3 p.m. is the second 30-minute cycle of the last 90-minute cycle, which started at 2:30 p.m. Right.
Right.
What happens? The reason why I took this trade because at 3:30 it sweeps. You can see how all price did was pin this 30-minute cycle high, right? Remember, it started at 3 until 3:29. All price did exactly at 3:30, it pins that high. That is a liquidity sweep. The other term is a run. That's when price closes above, right? So it has to do either a run or a sweep, right? Now, when price did that, this is also sweeping in that same motion. It's sweeping a 10-minute cycle high because the previous 10-minute cycle started at 3:20 until 329. So it's sweeping the entire 30-minute cycle high and the previous 10-minute cycle high. We look left. Is there anything else that they're sweeping? No. Right. So, I end up taking a trade over here based off of the model. The entry would have been a little bit lower, but it still worked out because this is a inversion fair value gap here,
Mhm.
right? I end up taking my trade in here off the fair value gap because it was just higher, so I can have a smaller risk. But if we're going to be mechanical, which is okay, especially when it's automated, you just got to let it be. Your entry would have been here,
Right.
right? And you just gotta the this is where it's like the safest bet to do, and I guess the easiest way to do this is structure that the stop will always be put at the swing point, right? The
Mhm.
previous swing high or swing low. Um, you know, I sometimes I get away with murder because I would put the stop in this case above. So wherever the inversion, the high of that original gap, I will put my stop up there above that. But I feel like if we're gonna do this, you might want to put it at the swing high, which will be more risk in certain cases. Like this was way more risk than you needed it to be. It's still
Well, and,
fine.
and these will be adjustable parameters within the settings. It's not going to be hard coded.
Okay.
So if you
All
want
right.
to take less risk, you can decide that.
All right. Cool. All right. But that would have been your trade there because I know, most likely we already have. I mean, let's see if it's actually there. It'll just pop up. You have the SMT. Oh, yeah, it already pops up. So you'll see it here. So you can see it here. Let's take this off. All of these SMTs popped up. Right. So you had SMT between ES, 10-minute cycle SMT, 30-minute cycle SMT, 90-minute SMT with ES and YM, and also 3-minute SMT with YM. So you had a lot of cycle SMT here. After that, you would get your inversion fair value gap. Again, that's your entry trigger. Entry would have been right there, and you would have let that thing go. And you already had your sweeps, your right here. So you have your liquidity sweep, you have your cycle SMT, you have your inversion fair value gap. Now, if we go to the higher time frame here, we want to see price delivered here. Again, this is a 90-minute cycle high, right? This is 1 o'clock's cycle high, right? So it didn't deliver into a fair value gap or delivered into a order block. It delivered into a cycle high and swept a cycle high. So that's higher time frame liquidity ran, check. We went to the smaller time frame. We noticed that that's where we ran that liquidity. We had some 1 minute liquidity ran with the SMT. All these SMTs popped in. Great. The entry trigger is the higher time frame. So we were going to write this out again. Rule number one, higher time frame point of interest or key level. And I defined the key levels as, again, 90-minute cycle high and low, session high and low, daily high and low, yearly high and low, monthly high and low. You got it, right? That is a key level that price would have to deliver into on a higher time frame. I have to
Right.
see that type of delivery. Then on the lower time frame, which is always going to be the 1 minute, I would then have to see the cycle SMT. Then I would have to see the inversion fair value gap. That's it. That's how simple this model is, right? But the key point is price delivering into that higher time frame point of interest or key level. Or I'm not even key level. I'm sorry. I'm saying key level. I'm sorry. Time based liquidity. Yeah, that's what we want to say. I'm sorry. So it has to deliver into a time based liquidity or higher time frame point of interest. Sometimes it may do both, which is fine. But in this case, if we went to a higher time frame, we didn't have any reference as a point of interest to look at this time. All we had was that time-based liquidity, which was a 90-minute cycle high that price delivered into. So I'm assuming, okay, potentially I can sell here. I need to see the cycle SMT, which it did popped in, and then I need to see an inversion fair value gap. That's how simple it can be. All right, let's go over another example, or let's go over a buy example, right? So let's get one where price is delivering. Let's get this one right here. So we can see here what happened. Price delivered into a 15-minute breakaway gap. Check. Then what I need to do on a 1 minute, I need to see cycle SMT, inversion fair value gap. We can take a buy. All right, let's see if we got that. What time was this? 11:45 on Thursday. Let's see if we got that. What was Thursday? Thursday was 30th. Let's just go here and then move over. All right, cool. So look. Let's see if we got any SMT here. Start new. We do have an inversion, but let's see if we got any SMT. Yes, we do. So clear as day. You'll see in this one, you see price delivers back into the 15-minute breakaway gap. And then the SMT that pops in is all the way down here. You'll see that the SMT is a 30-minute SMT with YM and a 10-minute SMT with YM. After that, what are we looking for? Inversion fair value gap. That's it. Now, I did add in some other rules as well, just to qualify the inversions. And the rules to that, I want to say the inversion should happen within 3 to 5 candles for it to be A plus. So what do I mean by that? We created a fair value gap here. This is a bearish fair value gap, right? Candle 1 would be here. Candle 2 closes above. That's within 3 to 5. That is an A plus inversion setup. I can take that without fear. And you just took that trade. And that thing went.
Can I just go back? Can you go to the bottom of that chart again?
Yeah.
pull it up where you pointed out what's below there, the 30 and the 10?
Let me just get back the bar so you can see. I don't know why it changed.
Oh, they just disappeared.
Yeah, they disappear because it's more SMT was created. So with the indicator, um, it's only recent. I don't know how recent, but just recent one. So it would leave eventually when it gets all the way over here. All of this would have been gone, but in the moment, it's going to show you the actual SMT, which it was here comparing over here, which is the 30-minute, and this was the 10-minute,
Oh,
and
so
that's what.
that's not relevant to what's going on with what you're pointing out right now?
Yes, it is. Yeah, this is right. This low, they're comparing this low, right, over here. So these lows, and what's saying basically what's happening here is that on YM, this low was lower. That's it. That's what it's saying.
Oh, but it doesn't correlate to the level between 27,316 and 27,304.
Oh no, so that's the thing. When SMT doesn't correlate with price.
No, I'm just saying on your screen, they're below what you're talking about, but they're to the right where the numbers,
Mhm.
it's
Yeah, so
between 27,316 and 304. That's not relevant to where those are over there, correct?
no, it's not.
Okay, I got
Because
it.
like
It's just
yeah, because again, when you're talking about SMT, it's about the price. It doesn't. I mean the time. Sorry, it doesn't matter the price. Because what's happening here, the type of SMT that we do is it's comparing the entire 30-minute cycle, right? This entire 30-minute cycle. So basically, it's comparing 11 until 11:29. And whatever was the lowest point here, what's happening is that on YM, this low was higher. That's it. So that's why you
right.
see this. This is making a lower low on YM. It was making a higher low. That's it. That's all it's saying. Same thing with the 10-minute. If you look at 10-minute, you're comparing the 10-minute cycles. This 10-minute cycle started here, and let's see where's 9. So this is the whole 10-minute cycle here. So they're comparing this previous 10-minute cycle here. So basically it started at 30. Where's 30? My bad. Wait. 29. Yeah, 30. So basically what they're saying, you see how the line is at this low. So this was the lowest here. And on YM, that low was higher. That's it. That's all they're saying. But
Yeah,
this is
I guess I'm kind of confused as to what YM has to do with NQ when that's on your chart.
okay. So YM is so when we're talking about SMT, SMT is comparing correlating pairs. So what correlates with NQ is ES and YM.
I see.
So the Dow
Okay,
Jones, right, S&P 500, they are correlating. So
I got it.
the thing about SMT, it just shows you the crack in correlation. So supposedly the theory is when there's a crack in correlation, that is a quote unquote institutional footprint, or it's a sign that something is happening there and you should pay attention to that. So we use it mostly to confirm reversals and continuations, right? So we want to see that SMT around, especially with this model, because it's mostly reversals. Like you can see, if you're a smaller time frame trader,
price was selling off, and then it stopped here. To confirm this stopped, you probably had some levels here, like we had a zone here, whatever. Just to confirm this, we would want to see SMT. And then after that, what I would consider a change in state of delivery, which it happened after, but I also consider the inversion of change in state of delivery. Now I know that there's a high probability that price should continue going higher, which of course it doesn't always, because trading is about probability, but there's a high probability that price should go higher. And we're not going to be looking for a lot. You shouldn't look for a lot on these moves. But yeah, that was a great trade to take. But that's how simple this model is. The shot clock model is. It's higher time frame delivery into a point of interest or a time-based liquidity. Go to the 1 minute time frame. You want to see SMT divergence. I mean cycle SMT divergence. After the SMT is printed, you want to see a inversion fair value gap that happened within 3 to 5 candles. And the last little, I guess, to add on to it is, in these cases, I like when it's a single gap, right? To inverse. See if there's an example where you have multiple gaps. You had one right there. No. Okay, here, this one failed. So not that it failed, but this is not it. So you can see this one here. We have two gaps right after each other.
Right.
This is one I don't want to take. I don't want to take this. Right? I want to take ones that have a single gap on that leg that's going down. Right? Because what has to happen is price most likely would have to close above both of the gaps. So when that happens, the close above is actually here. Now, granted, if you had your stop loss all the way down here, price never came back for you, and you caught some profit. But the ones that we really want to take is the ones that have a single gap. So I would filter it to a single gap within that price leg that goes down or go up. Those are the money ones. Same thing here. Like you can see on the other side of it. This is beautiful. You see the leg up. Some people would call this the manipulation leg. The leg up here, it has a single bullish fair value gap, right? And then candle one, when you get candle one that closes right up below, I'm telling you, it's a go. So it did not take any time for price to come back below. And you can see here, what do we have above? We have a 90-minute cycle SMT here at this point. Mm-hmm. So that led to a beautiful, quick little short. And you would have took that beautiful short. That was beautiful. And that thing went. So what I do like about this is these trades, they happen on both sides of the market. As long as the confirmations are there, and you'll see, and I guess the testing, you'll see it's a high win rate when you get them.
It's a what?
High win rate.
High win rate.
Yes, very high win rate. The thing is it like 20 of these a day? No. But you'll get a couple that's really good if they meet the requirements that I set. There's other ones that you'll see, but they don't meet the requirements that I set. Yeah. And the last thing I did not add, I add the open price to the requirements, but I only added, I don't know if I said only the hourly open price, but what you need to add to it is the cycle open price as well. Right. I probably said the 4 hour open price, the hourly open price, and not the cycle open price. And this is what I mean by that. So for example, for this trade, 11:30 is the new 90-minute cycle open. The previous cycle was 8:30. I mean, sorry, 10 o'clock. It was 10 o'clock. The previous cycle for that was 8:30, right? So when this cycle opened, the inversion that you would have took was above 11:30 open. It was also above the hourly open, which is 11 o'clock, right? So 11 o'clock was right here. This was 11 o'clock open. And it was also above the current 4 hour open, which was 10. So that's just telling me that I'm selling at a premium because I'm above all three of those opens, right? And that's why
Repeat that last. Wait, repeat. You didn't come through. Repeat that last sentence.
so it's just telling me that I'm selling at a premium because you want to sell at a premium and you want to buy at a discount. So if I'm looking at the current 4 hour candle, the current hourly candle, and also the current 90-minute cycle open, and I want to sell, I want to sell above those open. If I'm above all three of those, just consider that the highest probable sell situation that we can get into because I'm above all of those opens, right? Now, here, when we took the buy, right? If we took a buy here, we are buying above 11 a.m. open. We're buying above 10, which is the current 4 hour, but we are still buying below the current 90-minute cycle open. That is still valid for me to take a trade. I can take that, right? So that's part of the rules as well. When buying, we want to buy below the opens or at, but most likely when you'll see we're taking an inversion, it's really you want it to be. It's going to be below. It's not going to be. It's going to be rare where it closes exactly at the open, right? But most of the times you'll see that you're buying below, right? If you get a nice inversion. Over here, this was inversion too. I'll show you. I saw this one. Show you this one real quick. So we had an inversion here too. Let me see if it pops up. It was small right there. So it was really small, but everything was there. At this time, we were below the 10 a.m. open, which is the hourly open. This is also the new 90-minute cycle open, and it's the current 4 hour open. So trading at 10 o'clock to me is one of the best times to trade because 10 o'clock itself is a 90-minute, 4 hour, and hourly open, right? Very powerful level. So if I want to buy the 10 o'clock candle, 100% I want to buy below it. You'll see we get our confirmation here because we get
Cycle divergence. Down here we're at YM. You can see when price closed above. When price closed above, this already does a change in state of delivery. But again, that's not our entry trigger. Our entry trigger is a inversion. This is a single candle here. And now look how long it takes though. So it's created here. So we have 1, 2, 3, 4 candles it takes to inverse this small baby inversion. It's very small. Like you can see, this is very small. And it inverts on this candle, that would have been your entry right here. But again, this is a valid buy for me because I'm like, at least I'm buying below the 10 a.m. open. And then you can see this thing, it goes, it rips. Right? It's beautiful. So that's how you would have took this trade there. So trading with that logic, the open price logic, it puts you in a better position probability wise because again, if we look at any candle, right? I'm on a 1 hour time frame. I'm just gonna take this off real quick. If I look at a bullish candle, any bullish candle, let's say this one right here, right? And again, this was the 10 o'clock candle. This 10 o'clock candle here, first of all, you can see what it did. It swept liquidity there for sure. I know this is the Asian low. No, that's the Asian low. So it swept liquidity. But you're buying, and it swept the 9 o'clock low too. But you're buying anywhere in this wick, that means you get to experience the expansion. Same thing on the selling side. If I brought anywhere above, candle opens here, if I brought anywhere above here, I get to experience this whole sell on a selling candle, right? So unless you get a candle like this that opens, it just goes up. But most of the time, you do want to buy below the open or you want to sell above the open with the same context that we're talking about, with that criteria of higher time frame, lower time frame, S&T inversion. Give me my money. That's it.
Could I go through a few things
Yeah.
that were written with you?
Yeah.
Would you mind stopping the video and then restarting it so it can be part 2?